Welcome back. When you construct a building, its survival depends entirely on its foundational structure and its ability to withstand extreme vibration and stress. The exact same principle applies to building a portfolio for financial independence and early retirement. We are constantly taught that the foundation of a safe portfolio is global diversification, spreading your capital across Europe, Japan, and emerging markets to mitigate risk. But what if the global financial architecture is not a level playing field? What if, in your attempt to diversify, you're actually moving your capital out of the only structure designed to withstand severe economic stress? Today, we are moving beyond simple stock charts. We are going to analyze the deep structural integrity of global markets. We will look at corporate law, currency hegemony, and demographic destiny to understand why the United States stock market possesses an unfair, insurmountable advantage over the rest of the world. To understand the U.S. market's dominance, we must first look at the raw physics of global finance, liquidity, and currency. The U.S. accounts for about 4% of the global population, yet its stock market makes up roughly 60% of the entire world's equity value. But size is just the byproduct. The real engine is the United States dollar. The U.S. dollar is the world's reserve currency. When you invest in international markets, you aren't just taking on business risk, you are taking on immense currency risk. If you buy stocks in a European or emerging market company and that local currency depreciates against the dollar, your actual purchasing power drops, even if the stock price goes up. U.S. companies, on the other hand, operate from the fortress of the reserve currency. They buy commodities like oil in dollars, and they price their global software in dollars. This creates a phenomenon known as the exorbitant privilege. During times of global crisis, when a pandemic hits or a war breaks out, what happens? Global capital panics and flees to safety, and safety means the U.S. dollar and U.S. Treasury bonds. This massive influx of global capital during stress tests inherently props up the U.S. financial system. While other global markets suffer severe capital flight and liquidity crunches, the U.S. market acts as a sponge, absorbing the world's wealth. For a FIRE investor, this means your capital is parked in the most stress-resistant structure on Earth.
Let's critically analyze the alternatives. Many diversification advocates point to Japan, the world's third or fourth largest economy, depending on the year. Japan produces magnificent engineering and technological hardware. However, a great economy does not equal a great stock market. For decades, Japan suffered from what economists call a balance sheet recession. After their massive asset bubble burst in the 1990s, Japanese corporate governance fundamentally broke down from an investor's perspective. Instead of maximizing shareholder value, companies spent the next 20 years paying down debt, hoarding massive mountains of cash, and engaging in cross-shareholding, where companies bought each other's stock merely to protect management from hostile takeovers, not to generate returns. The result? A market that stagnated for over 30 years. The Nikkei index famously took over 3 decades just to return to its 1989 peak. Imagine being a FIRE investor, dutifully saving your money and experiencing zero capital appreciation from age 30 to age 60. Japan teaches us a brutal lesson. Without a legal framework that legally mandates shareholder enrichment, your capital can be trapped in a zombie market, entirely eroding your retirement timeline.
If Japan is a lesson in corporate governance, Europe is a lesson in structural friction and innovation suppression. Over the last 3 decades, the global economy has been entirely rewritten by software, the internet, and cloud infrastructure. During this massive wealth creation event, Europe essentially sat on the sidelines. We must ask, why are there no European equivalents to Apple, Microsoft, or Google? The answer is fragmentation and hyper-regulation. If a brilliant software engineer creates a startup in California, they instantly have access to a unified, frictionless market of 330 million wealthy consumers operating under one language and one overarching financial system. They can scale at lightning speed. If that same founder starts a company in Paris or Berlin, the moment they try to scale beyond their borders, they face a nightmare of architectural friction. They must localize software into dozens of languages, navigate vastly different labor laws, and comply with the most aggressive regulatory bodies on Earth, such as the GDPR or the new AI Act. Europe has positioned itself as the regulator of the world, while the U.S. has positioned itself as the innovator of the world. For capital to compound rapidly, it requires an environment of low friction. The European market, while culturally rich, is structurally designed with too much friction to produce global tech monopolies.
This brings us to a fundamental long-term metric that cannot be manipulated: demographics. A stock market's growth is inextricably linked to human consumption and human capital. If a population is shrinking and aging, domestic demand drops, innovation slows down, and pension burdens crush the economy. Japan's median age is approaching 50. Much of Western Europe is rapidly aging, with birth rates far below the replacement level of 2.1. This demographic winter is a structural headwind that is almost impossible to reverse. The United States, however, holds a unique trump card. While its native birth rate is also declining, the U.S. operates as a massive magnet for global immigration, specifically high-skilled immigration. The smartest engineers from India, the brightest researchers from Europe, and the most ambitious entrepreneurs from Asia overwhelmingly migrate to the U.S. to access its venture capital networks. The U.S. structurally replenishes its human capital and consumption base by importing the top 1% of global talent. When you invest in the U.S. market, you are not betting against demographic collapse. You are investing in a system that constantly imports youth, intelligence, and ambition. Finally, let's talk about the actual mechanics of how you get paid. For a FIRE investor, taxes are your biggest enemy next to inflation. In Europe and many other regions, companies heavily favor paying out cash dividends to reward shareholders. While receiving a dividend feels good, it triggers a taxable event. Every year, the government takes a slice of your payout before you can reinvest it. Over a 30-year compounding horizon, this dividend tax drag destroys massive amounts of theoretical wealth. In the United States, driven by that relentless shareholder-first culture, companies favor share buybacks. Apple or Microsoft will use billions of dollars to buy their own stock off the open market and burn it. This reduces the supply of shares, mathematically forcing the value of your existing shares up. Because the stock price rises internally, it is completely tax-free until the day you finally decide to sell. The U.S. buyback system is the most efficient, frictionless wealth compounding engine ever engineered. Achieving FIRE is a monumental task. It requires you to be an architect of your own future. You cannot afford to build your financial foundation on markets that suffer from structural friction, demographic decline, or flawed corporate governance that ignores your interests. The dominance of the U.S. stock market is not a lucky coincidence. It is a meticulously engineered result. By capturing the scale of the U.S. market, you align your capital with the global reserve currency, the world's most aggressive innovation ecosystem, and a legal structure explicitly designed to compound your wealth efficiently. So, I leave you with this question. When stress testing your own portfolio for early retirement, are you trusting the nostalgia of global diversification, or are you trusting the hard math of structural supremacy? Let me know your strategy in the comments. Subscribe for more deep architectural dives into wealth building, and I will see you in the next one.